All right, let's talk about a tool that's kind of like a fire extinguisher for your portfolio. You really hope you never have to use it, but when things get chaotic, you need to know exactly how it works. We're going to break down how to buy VIX call options, so let's get right into it.
I want you to think back to March of 2020. That quote just perfectly captures the absolute fear that was gripping investors. The screens were just a sea of red, right? It felt like the bottom was falling out of the entire market. But while most people were watching their accounts just get crushed, a handful of traders were seeing gains of 300%, 400%, even more. So how on earth did they do that?
Well, that's really the million-dollar question, isn't it? How can you actually position yourself to not just survive a market crash, but maybe even profit from it? The answer, it turns out, lies in understanding an instrument that is literally designed to measure fear itself. So what even is the VIX? You can think of it like a thermometer for Wall Street's anxiety. Now, it's not a stock you can go out and buy. It's actually a number, a calculation that's based on the prices of S&P 500 options. When traders get nervous and start buying up protection, the VIX shoots up. When everything's calm and the market's just cruising along, the VIX stays nice and low.
Now, check this out. What's really wild is just the sheer scale of these spikes. On a normal day, the VIX is just kind of hanging out in the teens, right? But look at what happened during the 2008 financial crisis and the 2020 crash. It exploded to over 80. This massive, just absolutely explosive potential is exactly why these VIX call options can generate such incredible returns when panic hits the streets.
But hold on. Before you even think about opening your brokerage account, there is one single critical detail about the VIX that trips up almost everybody. I'm serious. Getting this one thing wrong is the absolute fastest way to lose money, even if you are totally right about a market crash coming. Okay, here it is. This is the big secret. The VIX number you see on the news, that's the spot VIX, and you can't trade it at all. Your VIX call option, the thing you're actually buying, is priced off of VIX Futures contracts, and those are a bet on where the VIX will be at some point in the future. This disconnect, this gap between the spot price and the futures price, this is everything. The spot VIX can go to the moon, but if the futures don't move as much, your option might not pay out like you think it will. And that leads us to this weird-sounding word, Contango. I know, it sounds super complex, but the idea is actually simple. Most of the time, the market expects things to be a little more volatile in the future than they are right now. This means those VIX futures prices are almost always higher than the current spot VIX. And that creates this constant headwind, this uphill battle for anyone buying VIX calls, because the thing your option is tracking already has a bit of fear priced into it.
Okay, so we get the theory. We understand the big secret about futures. Now, what do you actually need to get started? Let's talk about the practical, real-world tools you're going to need to even place a trade.
First up, you need the right broker. Not all of them will let you do this, especially a lot of the newer app-based platforms. You're going to need a more established broker, like tastytrade, which is built for options traders, or Interactive Brokers for all their advanced tools, or even one of the big guys like Charles Schwab. The most important thing is to make sure they offer VIX options and that they give you access to the VIX futures data we just talked about. And it's not just about the broker, it's also about your account with them. To buy VIX calls, you're going to have to apply for at least what's called Level 2 options approval. Basically, you'll have to answer some questions about your trading experience and how much risk you're comfortable with. It's their way of making sure you understand what you're getting yourself into. All right, this is the main event. This is the heart of our explainer right here. We've got the theory down, we've got our tools ready to go, so let's walk through the actual step-by-step process of buying a VIX call option. Before you even dream of clicking buy, you've got to run through this pre-flight checklist. First, where's the VIX right now? Is it super low? If so, your options will be cheap, but you might have to wait a long time for a spike. Is it already high? Then they're going to be expensive. Second, check that futures curve we talked about. And third, what's coming up? Is there a big Fed meeting? A major economic data release? You need to know why you think volatility is about to go up. Okay, now for the trade itself. Step 1, pick an expiration date. Go with a shorter one for a specific event, or a longer one to give your idea more time to play out. Step 2, choose your strike price. The further out of the money you go, the cheaper it is, kind of like a lottery ticket, but it's also riskier. Step 3, and listen up, this is absolutely crucial. Always use a limit order, not a market order. VIX options can have really wide price spreads, and a limit order protects you from getting a terrible price. And finally, have an exit plan before you even get in. Know when you're going to take profits or cut your losses.
So now you know how to buy a VIX call, but we need to ask a more fundamental question. Why are you buying it? Because there are two completely different ways to think about this tool, and you have to know which strategy you're using.
So, are you using it as a shield or as a sword? The shield strategy is all about portfolio insurance. You buy these VIX calls fully expecting that they'll probably expire worthless most of the time, just like you pay for car insurance hoping you never get into wreck. It's a small, consistent cost, but it's there to save your skin in a total catastrophe. The sword, on the other hand, is pure speculation. You're betting on a specific event to cause a very quick spike in volatility. With the sword, you get in and you get out fast.
And that brings us to our final and maybe our most important section. Using a VIX call is just like handling that fire extinguisher. It is an incredibly powerful tool, but if you don't respect the risks, you can get very, very badly burned.
Okay, the single biggest enemy of a VIX call buyer is something called time decay, or theta. Think of your option like a melting ice cube. Every single day that the market doesn't panic, a little piece of its value melts away. This decay is relentless, and it gets faster and faster and faster the closer you get to expiration. You can be 100% right that a crash is coming, but if your timing is off, time decay will absolutely wipe you out.
And this brings us to a really chilling nickname that professional traders have for this stuff. The act of betting against volatility, which is the other side of our trade, is often called the Widowmaker. Now, we're talking about buying calls, not shorting volatility, but the name itself is this powerful, stark reminder of the immense risk involved here. This is not a game. This is an instrument that demands your full respect.
Because at the end of the day, volatility is just a permanent part of the markets. Fear is inevitable. We know for a fact another storm is coming, we just don't know exactly when. So that leaves us with the final and most important question. Now that you understand the tool, how will you choose to prepare?